All right, GameStop. Let's talk about this situation, and I'll explain in plain English what happened. And also, I want to tie it into some themes that we're talking about on this channel because I think there's some really good takeaways that we can use to raise our game and raise our sophistication as investors. And also, I guess I try to avoid current events and kind of punditry related situations. I think a lot of the financial media, when you traffic in punditry, it's not helpful really. It's more distraction. But this particular situation, it just offers enough themes that we can really apply and that fit in with what I'm trying to do with this channel. So I'm going to kind of break my rule of avoiding current events. So first of all, just in plain English, what the heck happened with GameStop? So first of all, it's just a garden variety short squeeze. And there is a firm called Melvin Capital which had put on a large short position for GameStop. And remember, when you're shorting a stock, what does that mean? You're basically borrowing shares that you don't own, selling them for cash now, and then with the intention of, in the future, buying those shares back at a much lower price. That's what shorting is. And, if you think about GameStop, okay, it's a physical retailer selling gaming gear, gaming equipment, gaming products. This is a sector of physical retail that's probably going to get digitized, right? So it's actually a reasonable thesis to be bearish on a physical retailer in that subsector of retail. So that I hear. Now, between when you have the idea of a thesis and when it plays out, a lot of other things can happen, right? And in particular, when you're shorting a stock, you have to pay attention to whether this short is crowded. And what does it mean? What is a crowded short? Well, so there's a number that people pay attention to. It's called short interest. And whenever you pull up a chart or a screen of any stock, in general, like on Seeking Alpha or on your brokerage website, it'll list the short interest. It's going to be right there on the main page of any ticker. And in general, you're going to see for most companies, most normal companies, a short interest of like 1 or 2% or a few percentage points. That's sort of a normal number. When you start to see, say, 10 or 20%, that could be a red flag. And in fact, if you have a holding where normally the short interest is a few percentage points, but you see it go up to 20%, that's a very big red flag, and it means you should go back and do some more homework on your company because somebody's identified it as a candidate for shorting and has put on a short position, and that probably means that there's some cockroaches in there, some things that are wrong, and you want to make sure that you're extra sure about your bull thesis on this company, or you want to at least be careful about why you own it and what for. So now, sometimes short interest can go much higher, so let's say 50 or 60%. That signifies a very crowded short. And that, counterintuitively, can be actually very bullish because whenever you short stocks, eventually you have to cover, right? But if more and more people are short a stock and there's just a small amount of buying pressure in this company, you can actually send the stock a lot higher because the shorts can panic and cover automatically. This can drive a stock a lot higher just for technical reasons, basically. So with GameStop, it was a very, very crowded short. It actually had short interest that was 100%. I think now it's actually over 100%. That you don't see too often. That is a very crowded short. And if you know a specific firm that has a large short position that's in amongst all these other people short, all it takes is a small amount of collective buying to really move the stock quite a lot, and you can just create a really explosive short squeeze. In the case of GameStop, the stock went up something like tenfold in a matter of several days. And so this actually can happen. Periodically you see short squeezes, and because of this sort of short-term bullish phenomenon of an overshorted stock, people do screen for heavily shorted companies. They look for high short interest, and they might just put on a small speculative position of all these companies and just let it play. A lot of them, nothing will happen, or maybe the bear thesis plays out and it goes to zero or it goes down a lot. But every once in a while, you might have one of these stocks become an explosive short squeeze, and you can make an order of magnitude on your money. So this is sort of the thinking that goes on behind looking for high short interest companies. Okay, so what you want to do is you want to pay attention to the short interest on your stocks. If it starts to creep higher, do your homework again. If you see a company that, okay, there's admittedly a good bear thesis, but the short interest is very, very high, counterintuitively, you might actually want to speculate in a company like that with a small amount of capital, knowing you could lose it all, sure, but knowing that there might be upside, like meaningful upside. And then another thing to think about is what is the nature of the upside downside trade-off on any given investment that you have. This is very, very important fundamental concept, and it's one of the reasons why you don't want to short. Because think about it, the best you can do if you're a short on a stock and you're right, you can double your money, meaning you sell the stock for the current price now, you get that cash, and then you later cover for pennies on the dollar. So, close to 100% gain. But your loss can be infinite because you, in the case of GameStop, imagine you're short shares of GameStop at 20, it goes to 200, you got to pay 10 times the price that you shorted this stock at in order to cover. And obviously that's a disaster, and that's what happened in Melvin Capital, and basically it blew up the firm. So even their short position probably in this particular company wasn't that big, but if it goes up a factor of 10, this liability they have actually explodes upward in their face, and it caused the firm to be liquidated. It went bankrupt last night, and probably it's going to be liquidated. And so this is a disaster, right? So you want to make sure that you're not engaging in transactions where you have massive downside with, not that great a trade-off for upside. So what are types of transactions like this? Well, you want to avoid naked short positions. Obviously, you don't want to short stocks. You don't want to traffic in selling naked put options or selling naked call options. I'll probably do a video on that topic as well. But those are, again, trades that have unlimited potential downside and limited potential upside. Furthermore, you don't want to use a lot of leverage because the leverage can blow you up as well. And so it can tear you apart if the market moves against you. Okay, so that's one thing to take away. Then also, this gets to another theme we talk about many times in all these videos of epistemic humility, about being humble. You might have a lot of confidence in a bear theme on a company like GameStop or on some other company. You may have a lot of confidence on a bull theme for some company. You think it's going to go higher for reasons X, Y, and Z. But you have to know that you could be wrong, and you never want to be in a position where even no matter how bulletproof your thinking is, you don't want to size that position such that it can destroy you. And so you want to not be a smart boy. You don't want to be too clever by half. The people running Melvin Capital were smart boys. They had this theme. It was a good theme, but something happened on the way to that theme playing out that destroyed their firm. So don't do that. Remember, this is your capital, your family's capital. You want to protect it, and so you want to stay humble. Size your positions accordingly and know that you can be wrong. And again, this is a theme I'm returning to over and over again, but this is a hedge fund, a pretty well-known hedge fund. I'm sure they had very, very smart people running it, and it destroyed itself. And so, we're just regular individual investors. We have to be even more humble than these guys because it's our capital, right? So if it can happen to them, it can happen to us. So stay humble, okay? So that's the GameStop situation, some takeaways. As always, thanks for watching, and I hope these videos are helpful.